Well, happy Friday. I hope this week was reasonably peaceful for everybody, knowing that we weren't fully participating in any of the madness and mayhem that was going on Wall Street all week long. Uh, so, just a couple of quick points. Monday was what we call a breakaway gap, and that's really what caused me to step back and say there's something different. And you never really know exactly what that different thing will be. But when you have some of the stuff going on amongst the last couple of weeks with leverage and just some of the excesses that we were seeing, when that breakaway gap happened, it was enough for us to use the strength in Tuesday's morning session to unwind. And what we did is we purchased 7 to 10 year U.S. Treasuries by way of an exchange traded fund called IEF. We made some adjustments today on Friday to those holdings for a couple reasons. So let me just share my charts with you real quick, give you a real quick update and a little bit of perspective on what we think might be next, and then move on and hope you have a great weekend. So first thing I just want to share with you is, again, the picture of the S&P 500. And a couple of things have happened. Of course, we've had this crash, which thankfully we've not participated in. But it does appear that the market wants to give itself a little bit of a reversal. And it looks the same whether we're looking at the S&P 500 or whether we're looking at the Dow Jones Industrial Average or if we're looking at the NASDAQ. And the NASDAQ actually was able to eke out a very, very, very slight gain, 0.01%. So that being said, why did that happen? Well, right before the close, Chairman Powell of the Federal Reserve came out and said essentially that they're going to use whatever tools they can and whatever necessary to fight the uncertainty of this coronavirus. You know, of course, everyone always looks for a reason. Why are the markets down? And anyone that can ever tell you why the market is doing one thing or another is just guessing. Nobody really knows exactly what causes the market to move. It's just an odd beast. And so you look for clues as to what may be happening in terms of ultimately a top or ultimately a bottom. And I've shared with you before what caused us to presume or consider that we might in fact be very, very close to a top. So now we have to consider whether or not we might be getting close to a bottom. And so when we look at these particular charts, it's encouraging to see that these particular indexes, this is the NASDAQ, came down to this previous breakout level and basically hit it, breached its 200-day moving average, which is, you know, many times enough to scare out what we would call some weak hands, and end up slightly positive on the day. And, you know, that's encouraging. S&P 500 closed near the top end range of its day. Dow Jones Industrial Average closed at the top end range of its day. Interesting thing about this is this pink line, if I showed you, it goes all the way back into 2009. So that's the trend that has been in place, and you can see that that trend has been touched a few times during instances of fairly major lows. And so the fact that the Dow breached that level today very slightly and then closed in the top portion of its range is very, very encouraging. What we need is an institutional washout to give us some confidence that the reversal is here. And the quickest, easiest way to identify that a bona fide reversal is actually in place is with what we refer to as an upside day. And an upside day simply is a calculation based on the day's volume of those stocks that are advancing compared to those that are declining. And so what we're looking for is a 90% upside day or back-to-back 80% upside days. If we get that, that would dramatically change the perspective of the health of this market. And sometimes it happens very, very quickly after you hit a bottom. Sometimes it takes a little bit of time. And so let me give you an example. The best example is that is for me to roll back into 2018 on the S&P 500 and then show you what it looked like coming out of that low. So here we are. We all remember the fourth quarter meltdown of the stock market. Here's the S&P 500 bottoming out essentially on Christmas Eve. And then the 26th, the market hit bottom and then jumped up really hard, had another day that was up really nicely. Now remember, all this has happened and we still don't have what we would refer to as an upside day. But then right here on January the 4th, we had a 95% upside day, and that came on the heels of Fed Chairman Powell basically saying that they're going to support the market in one way or another. And then on the 9th, we got this thing called a breakaway momentum, or a breadth thrust. It goes by a few different names. But the bottom line is that this area right here was very, very valuable in terms of identifying that now's the time to reinvest. Picking a bottom is a fool's game. And anyone that wants to try to pick a bottom is playing with fire. It's incredibly hard, it's incredibly dangerous, and we don't want to try to do it. We just simply want to get ourselves close. And so that's why we have to have some type of a confirmation that institutions are going to actually come in and support the move in the market. And that's why we want that 90% upside day, or why we want the 2 back-to-back 80% upside days. And when we get that, it doesn't mean that the market's just going to fly off from there. And so here's another example. Let me share with you August, September of 2019. And we had 2 days. I apologize for the busyness of the chart, but I keep a lot of notes on here, as you can tell. But on August the 28th and August the 29th, right, which are actually these days back here, August the 28th and August the 29th, we had 2 back-to-back upside days. And so the objective would be to take a position the next day. It's hard to take a position the day that the volume is happening, because it can fall off, it can fall apart, and you end up with a day where you didn't get the confirmation. So you need the confirmation in hand, and when that happens, you'd take a position the next day. In this case, it would have been August the 30th. If we took a position on that particular day, you notice that the market ran up, hit this overhead supply, fell back down to this level right here. Now, if that were the case, and we took a position on August the 30th, the most that the portfolio would have experienced a drawdown was a grand total of 2.41%. Not terrible, right? So what we're looking for right now is an upside day. We want at least a 90% upside day, or 2 back-to-back 80% upside days. And if we get it, great. So what do I expect to happen? I expect that next week we're probably going to have a couple of days that are positive. It's all going to depend on what the volume is telling us. If we get a move to the upside and we don't get volume with it, in other words, it's not a 90% upside day or 2 back-to-back 80s, we're not going to re-participate. All right? That's getting into the environment of really short-term trading, and we don't want to do that. We simply want to put ourselves in a position to let the market work for us, but to do that, we have to have some institutional triggers that identify it. And so that's where those 90% or back-to-back 80s come into play. But that being said, with the market closing at highs for the session right here, and again, it's the same on the NASDAQ, the S&P, you name it, I'm anticipating that we get a couple of nice days this next week. It wouldn't surprise me that we come back up into this this solid white line area, or this blue line, which is the 200-day moving average. It wouldn't surprise me that we come up there and then, maybe back and fill a little bit. The one thing that we have to remember is that when we have a market where we had panic type lows, like what these several days generated, we usually have a test of these lows somewhere between 3 and 4 days after it happens. So what does that mean? That means if we get a couple of up days, Monday, Tuesday, maybe even Wednesday, it wouldn't surprise me to see us sell off and then ultimately test these lows one more time, either Wednesday, Thursday, Friday, something like that. So we have to be patient. So when we sold out on Tuesday, which was up here, right, and it was in this section right up in here because we sold when the market was actually on the upswing in the morning session, what did we do with the money? Well, we ended up purchasing 7 to 10 year treasuries with IEF, which is an exchange traded fund, right? And why did we do that? Well, we did that because long-term treasury rates were completely falling apart. If we look at this is a picture of long-term treasury yields that go all the way back to 1982 when interest rates topped. And it's been in this massive downtrend. That market had been in kind of a sideways consolidation for close to 8 years, and then it fell off and broke right through it. And this level here was about 1.3% 10-year treasuries. We're now at like 1.13%, right? 1.13% on a 10-year treasury. That's crazy. But This was a big, hard move, and it wouldn't surprise me to see interest rates move back up again before ultimately falling back down. I commented on one of my radio shows recently that it wouldn't surprise me all of a sudden to see interest rates in the United States negative. If that happens, then obviously bonds are going to do real well. But in the meantime, when we purchased IEF, we wanted a parking place for the funds. And then look at the move that we got on that. It's pretty big. So we ended up selling half of the position in IEF today just to take some profits, anticipate that if we get a move to the upside in the equity market this next week, that it's probably going to cause the Treasury market to slightly sell off a little bit. And so if we see a sell-off down into this range, then we'll probably start to recalibrate some of the fixed income for our holdings, especially those accounts that are much more conservative and have bond holdings as part of their stable core. So at any rate, that's what's going on. It is a day-by-day kind of thing because it's very headline-driven. It's very Fed-driven. Understand that right now we're sitting about 50% in IEF, which is the 7 to 10-year Treasury, and about 50% cash, getting ready to reallocate if in fact we get one of those 90% upside days or two back-to-back 80s. So until then, we continue to just take the data one day at a time and look for our opportunities. If you have any questions at all, please let me know. Chris at careformywealth.com is the email. Direct line 608-354-1977. As always, I'm super thankful to work for you. If you have anything on your mind that you want to chat about, let me know. Other than that, I hope you have an amazing, peaceful weekend. See ya.